Welcome to Money Matters TV. I'm your host, Mike Dever, founder and chief innovation officer of Brandywine Asset Management. And my two co-hosts today are Jeff Watkinson of Watkinson Capital Advisors and Eric Parnell of Great Valley Advisors. Hello there, Jeff and Eric.
Hi,
Mike, great to see you today.
Yeah, you guys as well. So I want to get going because as we were joking before we went live here, not much has been happening here. It's early March 2000, or it's early April 2026, and it's been all quiet on the front. Is that correct, or did I miss something happening over the last?
Yeah, too bad there's no headlines, no geopolitical events taking place, right? So far in 2026.
Yeah, no, it's been absolutely wild, and obviously with the attack on Iran and Hezbollah, and I mean, just across the board, there's so many moving pieces, and it seems like every weekend we get an announcement that is market moving, significantly market moving. And so is this something that people should be even paying attention to, or is it just all noise in the end? Do we care?
Yeah, I mean, we have 150 years plus of market history that tell us that, these geopolitical events are always taking place. You think about Venezuela at the start of the year. You think about, the Hamas attack on Israel that took place a couple of years ago. You go back to 9/11. You go back to World War II, for that matter. We see these events take place over and over again throughout history. There's a short-term market reaction. Sometimes it can last a few days, sometimes a few weeks, maybe even a few months. But more history has shown us time and time again that once any short-term uncertainty is removed, the markets quickly snap back. And a lot of times they'll end up higher than they were before the whole conflict started.
Okay, so whatever the underlying fundamentals are, I guess, are what you're saying, they always bubble up to being the truth. That's what the markets follow. This in between stuff. If you get sell-offs and you've got a strong underlying trend, you should buy it. If the underlying trends are weak, does that mean that you take advantage of periods where people feel euphoric? Because of, in this case, victory in Iran, for example.
Yeah, you make such a key point about the fundamentals, because that, there's not a very high correlation between geopolitical events and market performance. If anything, it's virtually uncorrelated. It's a lot of noise in the short term. But when you take a look at those fundamentals, economic growth, GDP, low inflation, whether we have high or low inflation, and corporate earnings on the equity side, those are the primary determinants of market returns. And if anything, beyond the humanitarian effects of geopolitical conflict, which can be tragic, from a market perspective that has no emotion or no feeling, a lot of times these events turn out to be buying opportunities in the end.
Okay. Do the underlying fundamentals going into Iran, were they positive or negative? And I guess let's maybe start with on the credit front. Jeff, what do you see with the muni markets that you're dealing in? What did you see going into Iran, and what do you see now? Has anything changed?
Well, that's a great question. I mean, Iran obviously has been on the headline, but in muni land with municipal bonds, there's headline risk. We saw headline risk with COVID, when the New York subway systems were empty and retail investors rushed towards the exits, overreacted. Headline risk is a real risk, especially with municipal bonds. But what's really interesting with municipal bonds is there's a seasonality trend. And what happens is we call it the January effect, because billions of dollars comes to market in the form of maturing bonds, called bonds, bond interest that needs a home. And in the beginning of January, there's not much new issuance. So more demand, and there's not a lot of supply. And it happened this year. January, February were two very, very strong months for a total return basis for municipal bonds. And then we go to March and into April, and there tends to be a lot less demand every year. Why is that? People are doing their taxes. They're not really looking to lock up their money until their taxes are done. They may need to sell bond to pay income taxes.
And Jeff, did I hear you say that it's been increasing, that sort of sell pressure over the last few years? Is it more in 26 than it was in 24, for example?
March of 2026 was one of the worst Marches on record. I mean, the municipal bond market was down, I think, 1.5% on the index, the Bloomberg Municipal Bond Index. Doesn't sound like a lot, but when you're looking at munis, it's a lot. And once we get past April 15th, the market tends to firm up. But there are these seasonality factors. I mean, 70% of the time it works every time. I mean, it's a strong underlying trend with the seasonality, with the selling pressure leading up to April 15th.
Okay. And what are you seeing now? Is there indications that it's a good time or a bad time to be buying munis, and how is it affected by the Treasury market?
Good question. I brought a picture to the presentation today, and this is from our friends at Bank of America, and this is the AAA municipal bond general obligation yield curve, and it goes back to March of 2025. That's the orange line. And then in December 25, you can see how steep the yield curve got. So bonds with a one to 6 or 7 year maturity were yielding less than 2.5% just in December, 3 months ago. Okay. And you've seen the dark blue line as of March 25th, 2026. It's moved up 45, 50 basis points, really 3 years out, and those lines converge around year 18. So that the title of the slide is AAA curve richer versus 1 year out to 18. And
so do you recommend people buy out further there? I mean, or where there's that, I mean, it's steep right out to 18. Does that make sense then to be buying longer dated?
Well, yes. And here's why. I mean, if you have a long runway for this money, 8, 9, 10 years, you can buy a AA rated municipal bond with a 25, 30-year maturity, priced to a 10-year call. We bought a bond yesterday at a 4.68 yield to that 10-year call. And, instead of buying, I mean, that's a tax equivalent yield of close to over 8%, even 8.5%, depending what state you're in. And long-term equities have averaged 9, 10% a year on a nominal basis over the last 50, 60 years. So, and you're priced to that call option in 10 years. So what we've been doing, and it's part of our strategy, is when a bond is 2 years, 3 years from a maturity, and we can sell that bond yielding, I mean, we sold bonds in February at a 2.24 yield, which with a 5-year maturity, locking in premium, and then repositioning that capital for that client, long-term investor, earning them twice as much yield. I mean, we picked up 100% yield.
Right. So, okay.
Hey, Jeff, I have two questions for Jeff, if that's okay. Sure. Because, from our view and kind of the asset allocation space, we saw the period from, like April through August as an epic buying opportunity in the muni bond space. And with what you described happening this March, it seems like another good buying opportunity. I was just wondering if if you see it the same way. And then the second question is, from in our asset allocation work, when it comes to municipal bonds, we like to leave that work to the professionals like yourself, hire managers like yourself. Can you explain why it's in the best interest of investors to rely on the professionals versus to try and go in and pick out muni bonds themselves on a custodial platform?
Absolutely. Thanks, Eric. I'll address the first question. Why is now a good time? And really, the people that invest in municipal bonds, they have a portion of their assets. They want to stay rich. It might be $500,000. It might be $1 million. They might have a lot of other assets in other real estate, private equities. And it's all about yield, cash flow, return of principal, predictability. And I mean, 4 years ago, you could go out 10 years. You had to go out 10 years to earn 1% in a AAA GO municipal bond, and it's on sale right now. It's a tremendous buying opportunity. And to answer your second question, it's a little more complex, but where a lot of individual investors, the whole ecosystem is very difficult. And here's why. Say you have an account at Schwab, say you have an account at Fidelity, huge custodian. If you go on their screen and look up a 20-year Pennsylvania municipal bond priced to a 9-10-year call, you're looking at somebody else's inventory. Those bonds have been marked up. You are the last buyer on that series of markups. Nothing wrong with the bond. It's, we're looking to buy that bond at a wholesale level before they've been through 2 or 3 profit centers and marked up.
Jeff, how much markup do you end up with in a situation like that?
Well, here's an example. We have a Virginia client, and Virginia, there's not a lot of supply, and they invested more money in February. And I've been looking in the secondary market, and we'd like to be on the bid side. The offer side you're the last buyer. And there hasn't been a lot of supply come in the market. We've been patient, but we still have money. We're in no rush. We're going to buy the right bond at the right price. And it's work. That's the work on the front end, getting that bond that client's going to own for at least 8, 9, 10 years to provide the income. And that's really it. You're looking at somebody else's inventory.
Okay. Now, we had a viewer question, I think, that came in. Do you have that? There you go.
Okay. Today's viewer question is from Grace Abbott, Boston, Massachusetts. What is going on in the private credit market? For example, Blue Owl Capital.
Okay, so this is interesting. Starts actually when I started seeing this stuff a few months back. It started reminding me of 2007, and Bear Stearns had some credit default swaps funds that were running into trouble. And it turned out to be, absolutely, the forerunner of what turned into the financial crisis in 2008. I'm not saying that's what's happening here. It's just that we're seeing Blue Owl, that private credit is, where people are putting money into a fund, that fund's then lending it out directly, sometimes to lower credit-worthy recipients, sometimes not, but they're going to these private credit firms to get the money, the companies are, instead of going to a bank. And sometimes there's a reason for that. And these companies provided Blue Owl some great returns to their investors. But once you start getting some cracks in that, and once you start getting a run for the exit from these fund investors, there's no liquidity on the other side. The loans have been made to the companies, and it's sitting in being used at the company level, not in Blue Owl Fund anymore. So the investors that want to get their money out of Blue Owl Fund can't. They start getting gated. And that even makes it a little more panicky for people in those funds. So what we've seen with Blue Owl is their stock has hit record lows. They've been getting downgraded, their credit ratings by Moody's and the other credit agencies. And the big question is just the start of something that could be bigger, or is it a one-off? My fear, and I kind of tend to thinking a little bit, is it's going to be a little more contagious before we find the end of it. It just seems to be how these types of runs work. So right now, I would say private credit, I'm a little concerned. At the same time, we're freeing up the ability for 401k plans to invest in different funds like this, which is one of those ironic kind of situations where, right, maybe in one of the riskiest times, you finally open it up so for some of the safest investments to be able to participate. So I do have some concerns there.
Mike, I think that's a great point. And it's, traditionally private equity, private credit has been, it's for accredited investors with over $1 million. You have to be accredited to invest in these huge private companies and now private credit. And your money is locked up. It's a liquid for whatever the stated terms are for that fundraise. And you know that you will be illiquid for 5, 7, 8 years. And now there's a push, why can't a non-accredited investor invest in SpaceX or other huge private equity companies and or private credit? And we've seen a rise of these interval funds where you have 5% quarterly liquidity.
Mm-hmm.
And just like what you were saying, when there's more than, I don't know if it's Hotel California, you can get in anytime you want,
Right.
but you can never leave. But again, rush to the exits. And this is the point we make with municipal bonds, why you want to own the individual bond. If you have more than $125,000, buy an SMA, have individual bond. Yeah, it's
rather than going into a fund that's got liquidity gating and you can't get out of, I guess. Yeah. Okay. Let's move a little to the just the overall economic side of things. And we talked about this right out of the gate, Eric, where essentially we're saying that the underlying trends, whatever's happened fundamentally, pay attention to that. Don't get swayed by what's going on in the geopolitical realm. What is happening? What are the things people should be looking at now, Eric, in the fundamental side of things? What are we seeing that's coming across that's report-wise that's of significance?
Yeah, there's a lot to be constructive about in the market. You even think about what's taken place since the end of January. Now, everybody likes to think about the market pullback that's taken place in and around the Iran conflict. But the reality of it is that the market was drifting lower on marginally lower, going all the way back to the end of January when it peaked just above 7,000 in the S&P 500. So the fact that the market is held up as well as it has, it's been down, but it would be reasonable to think it would be down a lot more when you have oil prices spiking from $55 a barrel in December up to $112 a barrel more recently, and all of the uncertainty that comes with this geopolitical conflict. But the market's held up reasonably well. And I think the reason that is because the underlying fundamentals to the market, they remain strong. You look at economic growth, for example, investors have been worrying for the last several years about an economic slowdown that really hasn't materialized on a sustained basis. You take a look at economic forecasts for GDP for the first quarter of 2026, and we're looking at maybe like 1.5% to 2% of GDP growth. You take a look at current projections for Q2, and we're looking at maybe north of 2% GDP growth. It's not robust growth by any means, but it's an economy that's expanding. And then you take a look at corporate earnings. corporate earnings were already projected to grow at a double-digit rate. Now, corporate earnings, mind you, are the primary driver of stock returns at any given point in time. Corporate earnings were projected to rise at a double-digit rate before the Iran conflict started. And the Iran situation gave corporate executives more than enough reason if they wanted to kind of pull back on expectations and revise estimates lower. And what we saw during the month of March is that corporations in the S&P 500 revised earnings higher by nearly 5% during this period of uncertainty. That's gives a signal of how sustainably solid the underlying economic fundamentals are for the market. And one added point, and this kind of gets back to the fixed income discussion we were having earlier, one of the primary determinants of bond market returns are inflation and inflation expectations. And despite the fact that we saw oil prices burst over $110 a barrel here recently, inflation expectations, forward inflation expectations have remained largely in check below 3%. That's solid. That's a good backdrop for the markets.
Yeah, I think the oil price spike, the main thing that was taking effect there that didn't negatively affect the market was the steep backwardation in the curve, where you had the front month go up to 115, close to 120 a barrel, but you were still $30 under that, going out to June, July, August, delivery. So people could still hedge, buy positions for future delivery at reasonable prices. Everybody was kind of baking in a quick resolution to the price hike and the war, and that's now what we're seeing. It's like that prediction that was priced into the market turns out to be pretty accurate. Now, do you see? Yeah, go ahead. I'm sorry.
No, I was going to say, there was a lot of focus on the fact that oil prices spiked so much, and like you said, it was front end of the curve or the front end of the futures market where the prices were spiking, but they were still relatively low a few months out. And the other thing is that we don't have to go that far back in time. The first half of the 2010s, oil prices were sustainably above $110 a barrel. And there was really no meaningful inflation effect that was taking place at that time. Or you go right before the financial crisis in 2008, we had oil prices that on an inflation adjusted basis were over $200 a barrel. And we didn't have an inflation problem then either. And that's a big contrast to where we were 50 years ago. The US economy and its inflation outlook isn't as sensitive to the price of oil as it used to be a long time ago.
You mentioned inflation being expectations being under 3%. Now the Fed's targeting 2%. They keep saying we want 2%. We haven't been at 2% in 5 years. And some of the latest, even pre-war numbers were coming out, were in the high 2s. Is that an impediment to the economy at all? Is there an interest rate level, for example, where people say, okay, it's too high, it's gonna impinge on economic growth? And a third kind of question along with this is just overall debt. 40 billion, or trillion, 40 trillion in debt, we're hitting. Does that at some point, I've been hearing it's going to trigger it since the 1980s. It's going to trigger some sort of epic collapse. Is it? It just seems like it never matters.
I'll start off, and then I'm interested to hear Jeff's expert views on this. One of the things that was a good byproduct of the post-COVID, post-Russian invasion of Ukraine period in 2022 and 2023 was that for the first time since the financial crisis, we finally saw the normalization of interest rates. I mean, we struggled for 13 years after the financial crisis to get the Fed funds rate off of the zero bound and to get any kind of meaningful yield out of fixed income. And, in the wake of COVID and the inflation that we saw and this, kind of some of the fallout effects of the Russian invasion of Ukraine, we saw the spark in inflation that caused the Federal Reserve to raise interest rates to historically more normal levels. And that created a healthier bond market environment. I would contend that the environment for fixed income investors and the inflation environment is a much more sustainable and healthy environment now than it was a few years ago. And I'll add one last point before I turn it over to Jeff. I remember, I was a college professor for 18 years, and before the financial crisis, it wasn't 2% that was the target inflation rate. 3% was kind of considered the standard inflation rate. And the economy was doing just fine for years at 3%. And I think we can continue to handle that into the future.
Yeah, Jeff, what do you think?
Yeah, I mean, we're obviously we follow the Fed announcements very closely. The last thing we want as fixed income investors is runaway inflation. It's going to erode your future purchasing power. 2.5% target 2. We really are watching where's the trend. Is it trending in the right direction? And just like Eric said, I mean, 13 years of artificially low interest rates, and the fear there was deflation. Deflation is real. I mean, deflation's bad. Inflation's bad. You want that happy medium, and yeah, I mean, things have definitely normalized, but we're definitely keeping an eye on the trend of the PPI and what inflation's doing, and it's very crucial.
Yeah, those zero and negative rates were pretty surreal. I remember in a Bloomberg interview I did, maybe it was a decade ago, and my comment regarding the long bond was it's the riskiest trade out there because you're getting 20 basis points or something on it. And people buying that, I mean, you have to look at that and know at some point it's going to be substantially higher than that, and that bond price is going to collapse when that happens. And but they're still selling trillions of dollars of them at 0 to 1% rates on it. Eric, do you have an answer to my question on the overall debt, the 40 trillion? Does it matter? Does the interest that we're paying on that matter, or is it just something you can continue to fund?
It's such a good question, and it's one of those slow moving freight trains, and it's one of those situations where it continues to lumber down the track, and everybody raises alarm bells about it, and it doesn't seem to matter. And like so many things, it's like valuations in stocks. They don't matter until they matter a lot. The same type of thing is true with national debt, is that it doesn't really matter until you get into a point where it matters a lot. And that's one of the key points that Jeff was talking about in terms of keeping inflation pressures in check. If deflation's bad, Great Depression, deflation's bad. Inflation is also bad. Sustainably high inflation is really bad. And that's one of the things we saw during the 1970s. There's a lot of entitlement programs that continue to need to be funded by an increasingly baby boomer to support an increasingly baby boomer generation in the coming decade, at a time where if we do see sustainably higher inflation, that means a greater percentage of our national debt, the cost to service that is going to become increasingly cumbersome. So is it a problem today? No. But it's something that we really need to keep an eye on over the next 5 to 10 years, because I suspect that by the time we get to the middle of next decade, it could be a meaningful problem that we're trying to fix.
It was great, guys. I appreciate it. This has been an interesting time we've been in. This is an interesting time for our show here today, and I appreciate it. Thank you, Jeff. Thank you, Eric, for being on the show with me again today. And our next guest on Money Matters TV is Bob Maloney, consulting partner of Era Group. He's going to talk about expense reduction. Until then, thank you for watching Money Matters TV, where your money matters. See you next time.